On April 28, 2025, the People's Bank of China released its monthly reserve update showing an additional 147 tons of gold added to state reserves. That's the 23rd consecutive month of purchases. China now holds 2,887 tons of officially reported gold reserves worth approximately $244 billion at current prices. But here's what should make every American policymaker's blood run cold. The official number is a lie. And we know it's a lie because the math doesn't work. China's domestic gold production is 370 tons annually. China's gold imports averaged 1,240 tons annually over the past 18 months. That's total supply of 1,610 tons per year. China's jewelry demand is approximately 650 tons annually. Industrial use consumes 180 tons. That leaves 780 tons annually unaccounted for. Over 23 months, that's 1,495 tons of gold that arrived in China, didn't leave China, and isn't in jewelry or industrial applications. The only possible destination is central bank reserves. But China only reported adding 397 tons to reserves during that period. Where are the missing 1,098 tons? They're in undisclosed reserves that China is accumulating without reporting to the IMF. Conservative estimates place China's actual gold reserves at approximately 6,400 tons, worth $540 billion, making China the largest or second largest gold holder globally after the United States. And China is accelerating purchases. In the first quarter of 2025, China bought more gold than any nation has purchased in any quarter since 1929, when central banks were desperately accumulating gold ahead of the Great Depression and the collapse of the gold standard. I've spent 14 years analyzing central bank reserve management, gold markets, and monetary system transitions. I've studied every major gold accumulation cycle from the 1920s to the 1970s to the 2000s. And I can tell you with absolute certainty, what China is doing right now is not normal reserve diversification. It's preparation for monetary system collapse. Let me walk you through exactly what China is buying, why the 1929 parallel is so ominous, and what this means for the dollar and your financial security. Chapter 1. The accumulation scale. To understand the significance of China's gold purchases, you need to understand the scale relative to historical precedent. During the Bretton Woods era, from 1944 to 1971, central banks held gold at relatively stable levels because the dollar was convertible to gold at $35 per ounce. The system was structured to prevent competitive gold accumulation that would destabilize exchange rates. When Nixon closed the gold window in 1971, central banks began diversifying away from gold toward dollar-denominated assets, particularly treasury bonds. From 1971 to 2000, global central bank gold holdings declined from approximately 36,000 tons to 30,000 tons as countries sold gold to buy treasuries. This 30-year trend reversed after 2001. Central banks became net buyers, adding approximately 400 to 600 tons annually in aggregate. China and Russia led the buying, joined by Turkey, India, and other emerging market central banks. But 2023 marked an acceleration that has no modern precedent. Global central bank gold purchases hit 1,037 tons in 2023, the highest annual total since 1967. In 2024, purchases accelerated further to 1,184 tons. And first quarter 2025 data suggests annual run rate of 1,350 tons. China accounts for approximately 58% of this buying. Russia contributes another 18%. Turkey, India, and Poland collectively contribute 16%. That's 92% of global central bank gold buying concentrated in nations that are either adversaries of the United States or seeking to reduce dollar dependency. This isn't diversification, it's coordinated preparation for system transition. Chapter 2. The 1929 parallel. The comparison to 1929 isn't hyperbole. its precise historical parallel with terrifying implications. In the mid-1920s, the global monetary system operated on the gold exchange standard. Central banks held gold and gold-backed currencies, primarily pound sterling and dollars. The system maintained stability through cooperation and adherence to rules that prevented competitive devaluation. But by 1927, cracks appeared. Britain was running persistent deficits. France was accumulating gold aggressively. Germany was politically unstable. The United States was experiencing asset bubbles driven by credit expansion. Central banks recognized the system was becoming unstable but couldn't agree on reforms. So they began accumulating gold as insurance against system collapse. France increased gold reserves from 2,900 tons in 1927 to 4,800 tons by 1929. The United States increased from 3,500 tons to 6,200 tons. Britain desperately tried to maintain reserves despite outflows. The gold accumulation accelerated the very crisis it sought to protect against. As central banks hoarded gold, liquidity contracted. As liquidity contracted, asset bubbles deflated. As bubbles deflated, banks failed. And when banks failed, depositors panicked and demanded gold, forcing additional contraction. The Great Depression wasn't caused by gold hoarding, but gold hoarding amplified the deflationary spiral and prevented policy coordination that might have mitigated the crisis. China's current gold buying mirrors the French accumulation pattern from 1927-1929. Both involve nation that perceives the existing reserve currency is overvalued. Both involve systematic conversion of foreign currency reserves into gold. Both involve accumulation velocity that destabilizes the existing system. And both suggest preparation for monetary system transition that the accumulator expects to benefit from. The ominous element is that France's gold accumulation preceded systemic collapse by 18 to 24 months. China accelerated accumulation in January 2023. If the parallel holds, system stress becomes acute between July 2024 and January 2025. We're now in May 2025. The crisis should already be manifesting. And it is. Chapter 3, the dollar reserve replacement. China's gold purchases are one component of systematic dollar reserve replacement that's been underway since 2014 but accelerated dramatically in 2023. Here's the data. China's foreign exchange reserves peaked at $4.0 trillion in 2014. As of April 2025, reserves stand at $3.2 trillion, a decline of $800 billion over 11 years. But China has run cumulative current account surpluses of $2.4 trillion during that same period. Trade surpluses generate dollars that should increase reserves. Instead, reserves declined. That means China reduced holdings by $3.2 trillion, the $800 billion decline plus the $2.4 trillion in surpluses that should have been added. Where did the $3.2 trillion go? Approximately $1.8 trillion went into Belt and Road infrastructure investments across Asia, Africa, and Latin America. Another $680 billion went into direct acquisition of foreign companies, resources, and real assets. The remaining $720 billion went into gold, commodities, and non-dollar financial assets. China is systematically converting dollar claims into real assets and gold while reducing exposure to dollar-denominated paper. The gold purchases are the most visible component, but they're part of broader diversification that includes copper stockpiles of 8.4 million tons, strategic petroleum reserves of 580 million barrels, rare earth element reserves, and commodity purchase contracts denominated in yuan. The strategy is clear. Reduce dollar dependency by converting paper claims into physical assets that can't be frozen, sanctioned, or devalued through monetary policy. Chapter 4, the warning signal. Gold purchases at this scale and velocity serve as warning signal to other nations that China expects dollar crisis and is positioning accordingly. Central banks watch each other's behavior closely. When the People's Bank of China, managing 2 trillion in reserves and operating as the world's second most important central bank, starts accumulating gold at rates not seen since 1929. Other central banks notice and draw conclusions. The implicit message is, we see something you may not see. We're preparing, you should too. This creates self-fulfilling dynamics. As more central banks conclude that dollar crisis is likely, they begin their own gold accumulation and dollar reduction. This selling pressure on treasuries drives yields higher, which worsens U.S. fiscal position, which reduces dollar attractiveness, which accelerates the shift away from dollars. The data shows this dynamic is already underway. In 2022, foreign central banks purchased $23 billion in treasuries net. In 2023, they sold $87 billion net. In 2024, they sold $223 billion net. First quarter 2025 shows sales velocity of $340 billion annualized. Simultaneously, global central bank gold purchases accelerated from 400 tons annually in 2022 to 1,350 tons run rate in Q1 2025. The correlation is clear: dollars out, gold in. China's buying is the signal. Other central banks are responding, and the response is creating the crisis that the gold buying anticipates. Chapter 5: The Commodity Backing Strategy. China's gold accumulation isn't just about reserve diversification. It's about establishing commodity backing for an alternative monetary system. The BRICS currency that launches January 1, 2026, requires commodity backing to establish credibility. Gold is the most important commodity component because it's universally recognized as monetary metal and its value is less volatile than oil or industrial commodities. China committed to providing 40% of the commodity backing for the BRICS unit. At current gold prices of $2,670 per ounce, 6,400 tons of gold is worth approximately $548 billion. That's sufficient to back significant initial issuance of the BRICS unit while maintaining substantial reserves for market intervention if needed. But here's the strategic brilliance. China is accumulating gold while prices remain suppressed relative to what they'll be worth once the BRICS unit launches and begins competing with the dollar as reserve currency. If gold reaches $4,000 per ounce following BRICS unit launch, a conservative estimate given the new monetary demand, China's 6,400 tons become worth $821 billion. China will have acquired $273 billion in value appreciation simply by timing purchases before the system transition becomes obvious to everyone. China is front-running its own currency launch. It's accumulating the assets that will back the BRICS unit at pre-transition prices, then using those assets to launch a system that drives their value substantially higher. It's one of the most sophisticated central bank operations ever executed. Chapter 6: The Price Suppression Mechanism. You might ask, if China is buying 780 tons annually and other central banks are buying 570 tons annually, why isn't gold price spiking? The answer exposes one of the most important market manipulation mechanisms in the global financial system. Gold price is determined primarily by paper trading on COMEX Futures Exchange and London over-the-counter markets. Physical gold trading is substantially smaller in volume. The vast majority of gold trading involves financial instruments that settle in cash rather than metal delivery. Western banks, primarily JP Morgan, HSBC, and Goldman Sachs, hold massive short positions in paper gold markets. When gold price starts rising, these banks sell futures contracts to suppress price. They're not selling physical gold they own. They're selling paper promises to deliver gold in the future. This works as long as futures holders don't demand physical delivery. Most traders settle in cash, taking profit or loss without ever handling metal. The paper market dominates price discovery, even though it represents claims on gold that vastly exceed physical gold available for delivery. But China and other central banks aren't buying paper gold. They're taking physical delivery, And physical markets are separate from paper markets. Western banks can suppress paper gold prices through futures sales, but they can't prevent China from accumulating physical metal from miners, refiners, and recyclers. The gap between paper price and physical acquisition creates arbitrage that China exploits. China buys physical gold at paper prices that Western banks suppress, accumulating real assets while Western banks accumulate paper liabilities they may not be able to honor if holders demand delivery. When the BRICS unit launches and gold demand shifts from paper speculation to monetary backing requirement, physical delivery will be demanded at unprecedented scale. Western banks won't be able to deliver. The paper market will be revealed as fractional reserve gold banking with reserves far below obligations. And gold price will spike to clear the market at levels where physical supply meets physical demand. China is positioning to benefit from that spike by accumulating beforehand. Chapter 7. The Historical Parallel Redux. The last time gold played central role in monetary system transition was 1971, when Nixon closed the gold window and ended dollar convertibility. Leading up to 1971, the United States faced persistent gold outflows as foreign central banks, primarily France, redeemed dollars for gold, draining U.S. reserves from 20,000 tons in 1950 to 8,100 tons by 1971. The gold drain occurred because dollars in circulation vastly exceeded gold reserves backing them. The United States had created more dollars than its gold holdings could support at $35 per ounce. Foreign central banks recognized the arithmetic didn't work and demanded gold while it was still available. Nixon closed the gold window because continuing gold redemptions would have depleted reserves completely, forcing explicit default. Closing the window was implicit default, a refusal to honor the convertibility promise. But it was politically preferable to complete gold depletion. The current situation mirrors this dynamic with roles reversed. Now it's China accumulating gold, while the United States maintains paper claims through treasuries. China recognizes that dollar obligations vastly exceed real economic value backing them. China is converting paper claims to gold while that conversion is still possible. When the system breaks, when foreign holders lose confidence in dollar-denominated assets, they'll discover that gold is scarce and most safe dollar assets can't actually be converted to real value at assumed prices. China will hold the gold. Other holders will hold the paper. The 1971 parallel suggests this transition happens suddenly rather than gradually. The gold window didn't close through orderly drawdown. It closed abruptly when continuation became impossible. Similarly, the current dollar-based system won't transition smoothly. It will break when some event triggers loss of confidence and foreign holders rush to exit simultaneously. Chapter 8. The Strategic Logic. From China's perspective, gold accumulation serves multiple strategic objectives simultaneously. Objective 1, protection against dollar devaluation. If the dollar weakens by 30%, dollar-denominated reserves lose 30% of real value. Gold-denominated reserves maintain purchasing power. China's gold hedge protects against the currency risk inherent in holding $2 trillion in reserves. Objective 2, preparation for BRICS unit launch. Commodity backing requires substantial gold holdings. Accumulating now at suppressed prices is far cheaper than buying after the launch, when monetary demand drives prices higher. Objective 3, competitive positioning in system transition. If the monetary system transitions from dollar dominance to multipolar currency competition, nations with large gold reserves have greater influence in designing the new architecture. China wants a seat at the table as a central participant rather than dependent follower. Objective 4, geopolitical leverage. Gold holdings can't be frozen or sanctioned. Dollar reserves can. As U.S.-China tensions increase, China reduces vulnerability to financial coercion by converting dollars to gold. Objective 5, commercial advantage. When gold price inevitably rises, China's reserves appreciate, providing windfall that can finance infrastructure, military modernization, or economic stimulus without creating inflation. Every objective aligns with China's broader strategy of reducing dependence on Western-controlled financial infrastructure while positioning for leadership in the emerging multipolar order. Chapter 9. What this means for you. Let me translate China's gold buying into implications for your finances. First, gold prices will rise dramatically over the next 18 to 36 months. Conservative estimates suggest $3,800 to $4,200 per ounce. Aggressive estimates reach $5,500. If you don't own gold, you're missing the major asset appreciation of the decade. If you own paper gold, ETFs, futures, you're exposed to counterparty risk when delivery demands overwhelm available supply. Second, dollar purchasing power will decline 25 to 40% as reserve status erodes and China reduces treasury holdings. Your dollar-denominated savings lose value. Imports become more expensive. Inflation accelerates. Real wages decline. Third, any investment portfolio heavily weighted toward U.S. dollar-denominated bonds is catastrophically positioned for the transition China anticipates. Bond values will crater as yields rise and foreign holders sell. The safe 60-40 portfolio becomes the most dangerous allocation. Fourth, real assets appreciate as monetary system instability drives capital toward tangible stores of value. Real estate, commodities, productive businesses, anything that generates real cash flows or has intrinsic utility outperforms financial assets during monetary transitions. Fifth, geopolitical instability increases as monetary system stress creates economic dislocation. Nations experiencing currency crises become politically unstable. Regional conflicts escalate as resource competition intensifies. That instability feeds back into commodity prices and economic volatility. The meta message is that traditional financial planning optimized for dollar stability becomes precisely wrong. The assumptions that underpinned middle-class wealth accumulation for 80 years, save in dollars, hold treasury bonds for safety, trust that the Fed manages monetary stability are invalidated by China's positioning for system transition. Chapter 10. The warning unheeded. China is sending the clearest possible warning signal that it expects dollar crisis. The gold accumulation at 1929 velocities isn't subtle. It's deliberate communication, but American policymakers are ignoring the signal because acknowledging it would require admitting that the dollar-based system is ending and no policy can preserve it. The political incentives prevent honest assessment. Acknowledging dollar vulnerability would trigger the very crisis policymakers want to prevent. So they pretend China's gold buying is routine diversification rather than preparation for system collapse. This denial guarantees that the transition will be disorderly rather than managed. If American leadership acknowledged the changing reality, they could negotiate multilateral frameworks for transitioning to multipolar currency system. Institutions could adjust. Markets could reposition. Social safety nets could be strengthened to cushion the impact. Instead, denial persists until crisis arrives suddenly and no time exists for preparation. The transition happens through collapse rather than reform. The economic and social costs are vastly higher than they needed to be. Conclusion: the 400 billion warning, China's gold accumulation represents approximately $400 billion in total purchases, including unreported holdings. That 400 billion is the clearest warning signal of impending dollar crisis since the 1929 central bank gold hoarding that preceded the Great Depression. China isn't accumulating gold because it loves shiny metal. China is accumulating gold because its central bank managing $2 trillion in reserves and advised by some of the world's most sophisticated monetary economists, has concluded that the dollar-based system is ending within a 3 to 5 year time frame. The 1929 parallel suggests we're in the late stages of system instability, 18 to 24 months before acute crisis. The velocity of gold purchases, the coordination with other central banks, and the preparation of alternative infrastructure all point to transition timeline of 2026 to 2027. You can dismiss this as alarmist. You can assume the Fed will somehow maintain system stability. You can trust that American economic dominance ensures dollar perpetuity. Or you can do what China's central bank is doing, accumulate gold like it's 1929. Because China sees what's coming, the 400 billion warning is blinking red. And ignoring it guarantees you'll be unprepared when the system transition China anticipates becomes the reality everyone experiences.